Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Chris Englebert with Englebert Investment Advisors. Chris, it's great to have you with me as always, and I'm really glad that we have you in here today, Friday, March 13th, Friday the 13th, and what a March it has been. As an investment advisor, you have your own firm, you have your book of clients. I mean, how are you dealing with clients in a market panic?
Well, and Jill, you're exactly right. This is literally a market panic. So Thursday, March 12th, we saw numbers that I've been doing this for 37 years that I've never seen before. One of the benefits, obviously, of dealing with a seasoned advisor like myself is that I've been through 1987, I've been through 9/11, I've been through 2008. This felt like those periods of time. And as difficult as it is with the news cycle to focus on it, you have to focus on what's going on, right, because it is important. But you also have to understand that there literally is a panic going on at this particular time.
All right, and I want to pull up actually your first slide here because you have a couple of bullets that you look through. What do they have in common? What are you dealing with on a psychological perspective? What's your asset allocation like? And as you had said, 37 years in the business, we have a generation of younger advisors, younger traders, younger money managers who have not really seen a very volatile market.
Yeah, you're exactly right, Jill. And so one of the things that's been happening is that we are now in the pure psychological side of the business where PE doesn't matter, valuations don't matter. It's literally get me out at any cost. And Thursday, March 12th, that's exactly what it felt like. For example, in the morning, I was selling some tax-free bonds, very good bids to raise some cash, to be able to buy equities at a future date. And the first couple of trades were very well, but then all of a sudden you saw the dealers starting to pull the bids back. And one of the things that I really think that the retail investor has to focus on is the asset allocation. Many of your younger advisors have seen this great, dramatic bull market that we've been in. And I think what's happened is that they've gotten many of their clients a little bit over allocated to equities. We were fielding calls the last 2 days, and I had to point out to people, you're 50% stocks, 50% bonds, or you're 30% stocks, 70% bonds. Mm-hmm. Whatever the market's doing and whatever the number is that they show on the screen as far as percentage-wise, that's not what you are down at this particular time.
Well, and that's a very good point to make because and what's very different than when we had 9/11, when we had SARS in 2003, everybody's on multiple social media platforms. So there's online media all over the place, and you're just constantly infiltrated with headlines. And I think part of that is the psychological panic as well.
Yeah, you're absolutely right. And that's where we are right now, where, again, like we said, we're trading on a psychological panic. And so what happens is literally within a 5-day trading period of time, you go from extreme fear to extreme euphoria. Markets down 2,000 points, markets up 1,000 points. I mean, we're really compressing in a very short period of time many emotions that many investors literally haven't experienced over literally a 10-year period of time.
Right. I mean, think about it. I think 16, 17 trading sessions ago, February 19th, when we were at the high, markets were 20, 30% higher. That's a strong move.
Yeah, and nowadays what ends up happening, I call it the 3-month rule. So many retail investors, the first month they open their statement, they're down, it's no big deal. Second month they open their statement, they're like, I better call my advisor and see what he's saying. This is going to be the third month, depending upon what happens in the next week, where they're going to be down. And typically when you have 3 months down in a row, people start to panic. Now, what's even more troublesome is everybody has an app on their phone where they can pull up their account and literally intraday see swings of $20,000 or $50,000. So again, we're in the psychological aspect of the market. It's extremely difficult to deal with. I mean, literally as an investment professional, I'm sitting there and I'm seeing these numbers, and it has a psychological impact on advisors as well.
All right, let's take a look at your next slide here, because this is a positive part of the conversation, being in front of it, being proactive, teaching your clients so that they can be prepared for this. Let's go through some of these bullets.
Yeah, one of the things that, again, we have to re-educate clients on asset allocation, because when the market was going straight up like it was last year, I could tell you started to get older clients that are saying, hey, maybe I should have more money in equities, maybe I should have more money in equities. And we, again, have to re-educate them and say, what happens during the bad periods of time? I mean, everybody sees this mountain chart and they see the positive years, they don't see the negative years and what happens with their accounts during the negative years. So it's education, education, education again, because when volatility hits now, it really hit, and it's really hit obviously this week.
And I think it's going to be here for a while because there's still a lot of variables out there.
Yeah, there is, and that's why we talk about to clients what our game plan is, what our risk indicators are. Our risk indicators are more compressed than they were in December of 2018. So what we're talking to clients about is that this isn't going to be a recovery that necessarily snaps back in a week or a month. Wives, husbands, fathers, mothers aren't going to be jumping on planes, going to conferences. So we expect it to take a longer period of time. But by the same token, we're seeing numbers and valuations. I mean, I'm trying to point out to people that, last year at this time when the market really began to take off, we now, this year, have interest rates lower and energy prices lower than they were last year. So the other thing that I want to point out, and when we get to the charts, we'll show it again, is that typically when you have a sharp move down, you have some type of relief rally followed by another low. And whether we take out that low or not remains to be seen, but I've had conversations today already with clients going, hey, when are we going to put this money to work? And I'm like, not quite yet. You will be able to see when the risk starts coming down. And obviously one of the things we haven't really talked about is the VIX. We're seeing historic panic in the VIX, levels that we literally have not seen in 30 years.
All right, let's take a look at our first chart here. Of course, we'll start with the S&P 500, get a view of the broader market here.
Yeah, and I mean, there's a lot of technical...
I mean, look at that, 30% up and then...
Yeah. Tremendous technical damage obviously has been done. We're below the 200-day moving average, which everybody will tell you bad things happen below the 200-day, and they have. But it's important to note that we did not take out the December 2018 low. We think that's extremely important from that standpoint. Again, all eyes are going to be on the next rally that we have. We could literally, we're down 29% from the all-time highs. It would not be unconscionable to have a 15% rally in the context of a decline like we have. That rally is really going to tell you where the strengths and weaknesses are going to be for the rest of the year.
Right, and what's that old saying? Don't trust a bear rally?
Right,
Like you were saying before, we'll go down, up a bit, and then a little bit more of a flush. All right, let's move along to our next chart here, taking a look at the Nasdaq 100, which has been the relative outperformer.
Yeah, it's been the relative outperformer, and we actually believe, and you and I talked about this last summer when there was this whole shift, and it looked like value was going to come back, and unfortunately, the value stocks in this latest decline, the banks, the energy companies, really got slammed. We're looking at the Nasdaq, and from a relative strength standpoint, it is still leading. And if you think about it, if you think about companies that are going to be impacted by corporate shutdowns or work from home, the software industry, most of those people work from home already.
Right.
So it's really not going to have, we believe, the impact. But again, we don't want to count out the large cap growth. It still is showing the relative strength.
Yeah, I mean, does Microsoft have to be down as much as it is, right? And plus, well, also in the Nasdaq 100, you don't have financials in there, and there's not that much energy in there, which of course are two, underperformers.
Right. Yeah. And so we're looking at this thing that here's some opportunity here going forward, and we have clients in this particular area, and some of these large cap tech stock, the markets went down 30%, they've gone down 35, 40%, but again, they're higher beta, higher volatility. They will obviously perform much better on any type of rebound that we have.
How about the Russell 2000? This is still another index. This has not really been able to get out of its own way for quite some time.
Yeah, so the story here, we've talked about it for the last year. It's been a large cap growth, large cap tech rally, and you can see there's really been a massacre in the small mid cap area. However, I would like to point out the fact that we took out our 2018 low here with the Russell. One of the things that's happening is the Russell's dominated by highly leveraged companies, smaller companies. They don't have quite the access to capital. So you're seeing a tremendous decline in the Russell 2000. I truly believe at the back half of the year, when we get more clarification on what's going on with the economy and the credit markets free up, there could be a huge trade in the Russell 2000 as those companies, which I don't want to call them junk, but those lower quality companies could really lead a rally. And we're looking at this area because it is very undervalued at this point in time.
All right, moving on to our next chart here. Of course, taking a look at the 10-year Treasury. And I want to ask you this question again. You've been doing this for 37 years, right? It's not usual, it's very unusual to see basis point moves that we saw in March. I mean, 30 bips down in one trading session. bonds don't normally trade like that. Is that correct?
Right, and you're correct. And also, I think the other thing, basically what this is telling you, it's another fear chart. So, you have large institutional investors making asset allocation changes, and they're running to the 10-year Treasury as a safe haven. And the 10-year Treasury got driven down tremendously. Point that we'd like to make is, we've been a bear on interest rates for about the last 6 to 8 months. One of the reasons because international investors have piled into this trade, and we were concerned with the fact that the U.S. dollar is coming down, and you have international investors buying foreign or buying U.S. government bonds. If international investors haven't moved out of this trade now, and the dollar stays where it is, you could see a very sharp snapback in rates again in the back half of the year. So the other thing that, I'm on the phone, I'm either talking to clients or I'm talking to other money managers, and I've talked to several fixed income managers this week, and they're all saying the same thing. There's a lot of stress in the credit markets, but if you've got a 70 basis point or an 80 basis point 10-year Treasury and rates move up 80 or 90 basis points, you're taking a big loss because you're at such a low coupon on that Treasury. A lot of people don't realize that, and we think, to be honest, I think I have more concern of rising interest rates in the back half of the year than I do literally with the U.S. stock market.
All right, let's move along to our last chart here. Of course, crude oil. It's been tough in the crude complex, that's for sure.
Yeah, no question about it. And you can see we're back to 2016. I mean, what started this entire week was Sunday night. Obviously, what's going on with the Saudis, et cetera. They're really trying to set the stage, I believe, for the next 2 or 3 years with oil prices. If they're able to drive out and stress more of the U.S. producers, they may or may not succeed. But again, demand-driven, there's a lot of product out there, but the U.S. economy, is really producing a lot of oil. And the producers of oil, if you look at the per barrel cost, for example, the Saudis, the numbers thrown out there, that they have a $105 production cost. And what that means is all of the social programs that they have that they're paying for with their oil money, they need $105. So it'll be very interesting to see if they're going to be able to keep the lid on the oil market, because sooner or later somebody's going to blink. And when they do, obviously prices could recover. And you could see back in 2016, they only stayed down for a short period of time, and they immediately got back up into the mid-40s, mid-50s level. That seems to be where the equilibrium is for the global oil markets right now.
All right, Chris, great to catch up with you as always. Thanks for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.